Hey everybody, Steve Olson here with the Peak Group. I've still got JT with me. We haven't scared him away yet. We're glad to have him. So what we want to get into now is there are two kinds of loans that come into play when you use Peak's investor build model or when you use the concierge BRRRR model. So when we talk about the investor build, that is just, and I did a video on this a couple of weeks ago. We're going to have Peak build a property, right? You come in, you buy the dirt in an entitled project that we have, and you are going to get a construction loan for our construction team to build that property for you. And you're going to do this if there's some kind of a good spread or a wholesale deal for taking on the risk of a construction loan. But construction loans are not conventional loans. They're not debt coverage loans. Summarize a construction loan for us, terms, what it looks like, if you would.
Yeah, for sure. So a construction loan is technically a commercial loan, right? So there are some intricacies that come with that, right? They look at, how you qualify for it a little bit differently. We do our best to prep each of our construction lenders on kind of what we're doing, right? Hey, the goal of these are to ultimately term out into either conventional financing or a DSCR loan like we discussed.
That's how you're going to get paid back.
Mm-hmm. Yeah, that's how we're going to pay off the loan. Some unique characteristics to a construction loan, I'd say, is they're interest only, which is nice, right?
Okay.
Make it a little bit lower. One thing that I really like about construction loans is it's easy to know what the interest rate is because it's primarily based off the Fed funds rate, right? So right now that's 7.5. Every time we go into a new market, we typically try and find a bank that's local that we do these construction loans through. And we do our best to go in and kind of negotiate down those rates. So typically we're going to be prime, which is the Fed fund rate, and then they'll say plus. So you'll hear a lot of times they'll be like, hey, it's prime plus something, and we try and whittle that plus number down as little as we possibly can. But typically that's going to be 0.5 to 1, right? So just to make it easy, if we say, hey, your construction loan's prime plus 1, that's going to be a 7.5% interest rate, and that spread is going to be 1. So you're looking at a 8.5% interest rate.
I gotcha.
And then we'll set the term on it, right? So we'll say, hey, we think that this property is going to take 8 months to build. And then let's say we're going to plan on 30 days to refinance you out of that. So we may say we're going to set this loan term for 9 months at an 8.5% interest rate.
And always set it for longer than you think you're going to need it.
Yes.
What happens? We're going through construction. We're only 80% complete. And, at the end of the month, that note is due.
Yeah.
What do we do in that case?
So, a lot of times you'll see that we'll actually, even if we think it's only going to take 8 or 9 months, we'll usually set a 12-month term, right? And in the event that we go over that 12 months, the banks are usually really good to work with to extend your construction loan for whatever reason, right?
Yeah.
And that is something that we try and discuss up front with the bank that, hey, in the event that this will extend past 12 months, we need to extend this. So it's not a total shock. We've had some experiences where we've had to extend them for a significant amount of times, and banks have always been really good to work with to help extend those construction loans out.
How are interest payments handled during construction?
So we like to collect those up front. So a lot of times in your pro forma, you're going to see an interest reserve line item. So what we'll do is we'll go in, we'll calculate, hey, if this is a 9-month build time, we need to collect $10,000 up front for your interest so we can set it in your interest reserve account. And that way the bank can pull from that as we go through the build process. A big reason for this is, one, you as the investor don't have to worry about a monthly payment coming across that you have to pay for. And that also allows the bank to feel a little bit more confident with the loan, knowing that, hey, we have these interest payments set aside. And sometimes we actually use that as a negotiation tool to get you better terms on the construction loan.
Yeah, when we do a big build for rent community, a bunch of fourplexes, the bank sure likes a bunch of interest reserves getting deposited.
Yep. They're thrilled about that.
Yeah, that loan officer is getting employee of the month if they do that.
He is.
Yeah. So. Yeah. Okay. So they last, a year-ish, but that's negotiated. It's interest only. We know what happens when they run out. So what does the exit look like from a construction loan? What happens when it's done?
So when we talk to you as the investor up front, we'll take a loan application. We will, at that time, we'll pre-approve you for the construction loan and the long-term loan. So once, we work really closely with the builder. So once we know we're about 30 days out from getting our certificate of occupancy, we'll start working with you as the investor to get ready for that refinance, to refinance you into the long-term loan. So our goal is, as soon as you get C of O, we get you transitioned out of that construction loan, primarily because, the interest rate's going to be significantly lower. Right? I mean, in a construction loan, if we're at 8.5% and we can term you out into let's say a 7% interest rate, that's going to save you as the investor money. And obviously the banks want that gone as soon as possible as well. So, that's the goal, is to get you transitioned out of that construction loan as soon as possible.
Gotcha. So right now we've got our Pinewood Trace project in Alabama. We've got our East Powell duplexes in Fort Worth.
Yep.
So this is an applicable product for that. You're going to get a construction loan. You're going to prepay some interest reserves. You want to make sure you don't do anything stupid to your credit.
Yes.
During the build term, right?
Yep.
I mean, if you did do something moderately stupid, would that prohibit you from exiting the construction loan with a DSCR loan?
No. I mean, we can term out into whatever loan's going to be best.
Is there like a no-no on credit? Like, my credit goes down to 500, no more DSCR loans for me?
Yeah. So every lender is going to be, going to have different guidelines. But what I would say, typically you're going to see under 680, it's going to be pretty hard to find a loan. And once again, like I've always said, the worst you look as a borrower, the worse your terms are going to look, on the loan. So, there are always going to be products out there where maybe we can get below that 680 threshold, but you're going to pay for it. Right. So, typically we're going to have an outlet for you, one way or the other. And luckily we haven't run into a lot of situations where over the course of the build, all of a sudden we're just like, you don't qualify anymore. Right. We try and do a really good job of making sure that, you're in a good place. Even if it's tight when we're preparing the construction loan and we're pre-approving for the long-term loan, you'll know from us, hey, we need to do X, Y, and Z before we're ready for that long-term loan. And if you don't, you may not qualify.
I've helped a few investors sell that, life just happened.
Yeah.
During the construction loan, and you got to go to market. Yep. You got to pay the loan off.
Yep. And that's a scenario where you go back to the bank and you say, hey, X, Y, and Z has happened. We need to take this one to market. I don't know if we have an option to take this one out. And like I said, they're very good to work with.
They were always cooperative. They don't want the property.
No.
Right.
No.
That's a real, because they're just going to sell it anyway. Yeah. So if they feel like a good faith effort is being made to sell it, they're probably going to sit tight.
And one thing that we haven't talked about is usually we require 25% down. Right. Yeah. So you're in a good spot, in the property where there's usually going to be some equity there. We knock on wood, but we haven't had an instance where, we take out a construction loan and property values went down.
Yeah.
Right? More than likely they usually go up. Right.
Well, and that equity, and you're conceivably buying at more of a wholesale price too.
Mm-hmm. Yeah.
Because why would you do a construction loan at full market? It doesn't make any sense.
No.
There's got to be some upside. So, a couple of years ago, I built a house. Mm-hmm. We got a construction loan, and because it was an owner occupancy situation, I got this thing called a one-time close.
Yeah.
Right, where I signed docs, we build, and then I had to sign some modification thing that rolled it over into a permanent loan. Still doesn't exist on investment properties?
It does not. Every time we go talk to our banks, that is one of the first things that we ask, right? Yeah. Hey, do you have any type of portfolio program that allow us to do a one-time close?
Yeah.
Right. And that is just, you'll see it a lot for primary residences, but that is just not something that we have access to for
get access.
Properties. We're doing our best. We're trying. There's a lot of stuff that we're working on right now that will be super exciting, but that's just not something we have currently.
I think that's one of the things investors worry about is I closed on a construction loan at, prime plus a point.
Yeah.
I'm expecting interest rates to be 7 when I'm done. But what if all of a sudden they're at 8? They're worried about that time that the market adjusts to, and that's why they're clamoring for the one-time close. At least I can compartmentalize my risk. So I think you got to go into these things, running a stress test and saying, okay, if I do this deal and rates go way up, where am I at? Because you and I'm going through 2 of these myself.
Yeah,
where big problems with a builder, and rates. I think I was at prime plus one, which was 5.5 when it started.
Yes.
That thing went all the way up to 10.5 during the great interest rate psycho raise of 2022, and that got ugly. So the chances right now that rates double over a 9 to 12 month period, I think we can all agree are pretty slim. But you've got to think about these things.
Yeah, absolutely. And I mean, as of right now, as we sit today, right, the Fed is currently cutting, right?
Yeah.
I haven't seen anything recently indicating that they're going to raise rates, the Fed funds rate, which is tied to your construction rate. And so I think, we're pretty safe to assume that we're not going to see an increase.
Stable-ish.
Yeah. And as far as the long-term loan goes, one thing that we always do too is when we pre-qualify our borrowers, we kind of do that stress test. So if interest rates are 7%, we pre-qualify them at 8%.
Yeah.
Right.
Yeah.
Just to make sure when we get to the end and we're ready to term out that's just one less issue that we may have in the event rates do go up over the course of the build.
Higher risk, higher reward. Going into a construction loan, like JT said, make sure you can handle a slightly higher rate. Make sure you could handle making a little bit more interest payment over the course of construction. That takes a little longer.
Yeah.
And then you're doing that as responsibly as you possibly can.
Yeah. And one thing I think is important to note too, and I get this question a lot, is, hey, I put this money in my interest reserve account.
Okay? Yeah.
Let's assume a good situation, right? Fed cuts, maybe we get C of O a couple months earlier than anticipated, and I have that extra money sitting in my interest reserve account. Well, that's your money, right? That's not the bank's money. That's not a fee. That's not anything. So you can either choose to get that money back. You can apply it to your new loan. That's a question that I get a lot of, regarding that interest reserve account. So just know that when we take that money and deposit it with the bank, that's your money. Right. It's sitting there to pay interest. And if there is an excess of that at the end of the build, that's coming right back to you.
I would add, this is a really valuable tool. I mentioned the East Powell duplexes that we're doing in Fort Worth. Yeah. Those are located in a federal opportunity zone. So if you've got capital gains that you want to, I don't know if you can wipe them out or drastically reduce them, that those opportunity zone regulations change. But it's a great way to save on capital gains, but you have to build a property in an opportunity zone. And so usually you have to acquire land or an asset and put improvements into that asset equal to what you paid for the land. I'm really, really simplifying it. Check with your tax advisor, but on East Powell, the best way to do that is a construction loan. You acquire the lot from the Peak Group, get the construction loan. You're clearly putting more into the property than what you bought it for. And boom, you can take those gains and reduce them, if not eliminate them. So it's a good tool for that, especially.
Yeah, absolutely. And something to keep in mind too is, and correct me if I'm wrong, because we haven't dealt with a ton of opportunity zones, right? But financing does get a little bit different with opportunity zones. So you can do a conventional financing in an opportunity zone, but if you want to take advantage of the tax benefits of the opportunity zone, you have to incorporate, I believe.
Yep, you do.
And then once you do that, that will actually disqualify you from conventional financing. So
that's a good point.
That is that's an area where we may lean on DSCR. Right. If you need financing for a loan. So, the opportunity zones are great from a tax perspective, but we will look at them a little bit differently from a financing perspective.
And I'm glad you brought that up. I was going to just skip right past that. Yeah. So that's a good point. Okay, cool. So we got into construction loans. We've got a little bit of time left. Another unique product that we do is the concierge BRRRR model, specifically in Birmingham. There's a little bit of gossip that we might get access to some inventory in Fort Worth. I heard this yesterday. I don't know if you heard that yet.
I have not heard that, but that's exciting.
Breaking news for JT. Okay. So with the concierge BRRRR, we've got financing for peak funding that hits at a couple levels. You've got to buy this property using, Peak's debt fund. What are those terms like roughly? Can you speak to that?
Yeah. So right now we're looking at 12 and 2. So whenever you start talking about hard money or debt funds, you'll hear, it's going to be 13 and 2, 12 and 2. And what that is that's for the debt fund, we're looking at 12 and 2, which is a 12% interest rate and 2 points.
Yeah.
So,
okay. 2 points, 12% interest. We're packing that into the loan because you're not going to make payments along the way, or are you going to make it when it's paid off? Do you recall?
So that is something that we're still going through right now. I think it's going to be something similar where we may collect some of that interest up front,
Yeah.
to pay. And that may kind of ebb and flow, because the nice thing about the debt fund is that's our debt fund, right? So we are writing some of the guidelines for that. And so, that may be something that we need to come back to at another time.
But the intent is not write checks along the way. It's either prepay some reserves or it accrues and you pay it off when you close the loan out.
Yep, that's exactly right.
We're looking at typically a 90 to 120 day term, yes?
Mm-hmm. Yep.
And peak funding will give somebody the private hard money loan to acquire a BRRRR property in Alabama if that person goes through you to get pre-qualified for either a conventional or a DSCR takeout.
Yep, exactly. Because that debt fund is really meant to be short term, right?
Yeah, 3 to 6 months.
Acquire the property, rehab the property.
Yeah.
And then as soon as that is done, then we'll refi you into the long-term loan, right? So it's very similar to the investor build model, where we'll take a loan application, we'll pre-qualify you, for the long-term loan. That will essentially qualify you for, the money that we're going to use out of the debt fund. And then, we can move forward on that BRRRR model.
So somebody gets their property renovated. It's now rented. It's time to refinance, buy, renovate, rehab. Or you get the idea. All the R's. I get tied up on the R's.
Yep.
Okay. So they do all that, and now it's time to refi. My understanding is if they want to pull cash out, and I would say just because you can pull cash out doesn't mean you should.
Yes.
You're going to have, JT's going to have a really important role doing what we call sizing your loan. What is the optimal amount of leverage where we don't sacrifice and go to a negative cash flow position?
Yep.
Some people are okay going cash flow neutral. Some want to be as positive as they can. But on a conventional loan, you can't pull cash out for 6 months, right?
Yeah. So a lot of times there's seasoning requirements where you're not going to have the ability where, the property has to be in your name for a certain amount of time before you have the ability to take out cash. And so, and that's, as we've started the BRRRR process, I've gotten that a lot.
Yeah.
Right? Well, isn't the point of this to pull cash out? And yes, it can be, but that's, if you look at BRRRR, nowhere in BRRRR does it say cash out money, right? It could be a good option, but just know that, that's not necessarily the intent of this. If the property and the equity is there and it makes sense, like you said, if we can size it correctly and, you're not going underwater to pull a little bit of cash out, then great. I'm not, recommending we don't, but, I just think every property is going to be a little bit unique, and, we can dive into the details. And if there's an opportunity to pull cash out, great, let's do it.
Yeah. Where did your rents ultimately come in at? And I think to build on your point, let's pull cash out where we can.
Yeah.
And I'm using some very loose numbers here. You're going to buy the property for $100,000. You're going to have a $25,000 renovation budget.
Yep.
You'll put 20% of $125,000 down.
Yes.
Your costs for the hard money, so on and so forth. So maybe including your equity and loans, you've got like 132 or something into this.
Yep.
When this property is renovated, ideally it's going to appraise for, 200. And so the whole point is you have a $200,000 property for far less than the required leverage that you would have needed if you bought it renovated.
Yep.
Because you stepped up, you said, I'm willing to take some risk, right? And that's your refinance component.
Yep, exactly. And I think that's where a lot of the opportunity comes in with the BRRRR model.
Yeah.
Right? Is it allows you to get into an investment property for a little bit less than what it would be, is like you said, if you go buy one that's finished at $200,000 down, right? Because now at that point you have to put 20 or 25% down of the 200,000 versus 20 or 25% down of the 125.
Yeah.
Right.
So all in, you might be making the same cash flow, but you're 10 to 15% down.
Yep.
On the after repair value.
Yep. And and I think that's where, the BRRRR model gets kind of exciting, right? It's a great opportunity. And it's been really interesting. I've had some really seasoned investors get excited about it. I've had, investors that are maybe a little bit more new to real estate investing. It's something that, maybe is a little more attainable for them. So it's a great product.
Yeah, I really like it in Birmingham too, because that market is cheap compared to some of the surrounding big metros like Nashville and Atlanta.
Yeah. And
the unemployment rate is 1% below the national average.
Yeah.
The population is growing. It's business friendly. feels like a market you want some exposure to. And if
Yeah.
you could maximize your leverage and hold on to 5 or 10 properties while this whole story unfolds,
Yeah.
I think you could do pretty well.
Yeah. I think what I like about it the most is the expenses are low, right?
Yeah.
You go into Texas and insurance is so much, or like Florida properties, you can have really high insurance or property taxes become an issue. That's where Alabama, I think, is really appealing, is those low, expenses that we're talking about.
Yeah. Yeah, there's a lot to love about Texas and Florida. They've got their challenges like anywhere does.
Yeah.
But yeah, the property taxes, I mean, Google it. I think it's in the top 5 lowest of the country.
Yeah,
in
it's
Alabama.
great.
And Birmingham's far enough north that we're not getting clobbered on insurance either. Well, very good. Thanks for chatting through the construction loans and the BRRRR with me. Anything you want to add before we wrap it up?
No, I think that's good. Obviously, if you have investors or are investors that have any questions, I'm always happy to, help and answer questions as they come up.
Well, we're going to leave you alone for a while.
All right.
I'll bother you again in a couple of months.
Okay.
We're going to see where this mortgage situation is, what's going on with financing in, middle of 2025. But thank you for joining us. Thank you for listening, and we'll catch you next time.